In 2018, a Lebanese citizen could walk into a bank and withdraw their life savings. 1 year later, many couldn't. Their money was still there, but they couldn't touch it. How does an entire banking system trap the savings of millions of people? To answer that, we have to go back decades. Countries usually suffer economic disasters after losing wars, enduring foreign invasions, or experiencing some catastrophic event that destroys the foundations of society. Lebanon's story was different. For decades, it looked like one of the Middle East's greatest success stories. Beirut was called the Paris of the Middle East. Its banks attracted wealth from across the region. Its universities produced entrepreneurs, engineers, and business leaders. Millions of Lebanese built successful lives abroad, while maintaining strong financial ties to their homeland. On paper, Lebanon had advantages many nations could only dream of. Yet today, it is remembered for a collapsed currency, frozen savings, and one of the worst economic crises of modern times. The obvious explanation is corruption. And corruption certainly played a role. But corruption alone cannot explain why Lebanon's collapse became so severe. The deeper we investigate, the stranger the story becomes. Because Lebanon's collapse did not begin in 2019. The real story began decades earlier, during a period when Lebanon appeared stronger than ever. Long before it became a symbol of economic collapse, Lebanon was viewed as one of the most dynamic economies in the Middle East. Beirut occupied a unique position between Europe, the Gulf, and the wider Arab world. While neighboring countries struggled with instability and restrictive financial systems, Lebanon offered something different. Openness, capital moved freely. Businesses operated with flexibility. Investors found opportunities unavailable elsewhere in the region. Over time, Beirut became a financial hub. Wealth flowed into its banks, and Lebanon developed a reputation as a safe place to store money. Another advantage came from the Lebanese diaspora. Millions of Lebanese living abroad continued sending money home, investing in property, businesses, and bank deposits. Year after year, dollars flowed into the country. For a small nation with limited natural resources, this was enormously valuable. The future looked promising. Then came a major turning point. When Lebanon's civil war ended in 1990, the country faced the enormous challenge of rebuilding after 15 years of conflict. Infrastructure was damaged, economic activity had been disrupted, and entire neighborhoods required reconstruction. But alongside the destruction came optimism. The reconstruction effort transformed Beirut. Roads were built, downtown districts were restored, and construction projects reshaped the skyline. Foreign investors returned. Businesses expanded, confidence grew. A key part of this recovery was the decision to maintain a stable exchange rate between the Lebanese pound and the US dollar. Stability restored trust. Businesses could plan, investors felt reassured, and citizens believed their savings were secure. The strategy appeared to work. Money flowed in. Property values rose. Consumption increased. The recovery looked real. But beneath the success story, a dangerous dependency was emerging. Rebuilding a country is expensive. Much of Lebanon's recovery was financed through borrowing, and that borrowing required funding. Fortunately, Lebanon appeared to have a solution: its banks. Over time, Lebanon's banking sector became one of the largest in the world relative to the size of the economy. The system seemed elegant. Diaspora dollars entered Lebanese banks. Banks used those deposits to finance government debt. The government funded spending. High interest rates attracted even more deposits. And the cycle repeated. Everyone appeared to benefit. Depositors earned attractive returns. Banks generated profits. Politicians gained access to financing. The economy kept moving, but hidden beneath the surface was a simple reality. The entire system depended on one thing: fresh dollars. As long as money continued flowing into Lebanon, the machine kept running. The moment those inflows slowed, everything would become far more fragile than anyone realized. The weakness that eventually destroyed Lebanon was not immediately visible. To most observers, The economy looked active. Banks expanded, construction projects multiplied, and money moved constantly through the system. But financial activity is not the same thing as productive growth. Strong economies generate income by producing goods and services that the world wants to buy. While countries like Germany and South Korea generated wealth by selling products to the world, Lebanon increasingly relied on money coming in from elsewhere: remittances, tourism, foreign deposits. The difference seemed small. It wasn't. Instead, it increasingly relied on remittances, tourism, foreign investment, and bank deposits. Different sources. The same dependency. Each dollar entering the country helped support an economy that consumed more than it produced. For years, nobody seemed concerned because the dollars kept arriving. But history had seen this before. Argentina repeatedly built economic models that depended on confidence and external financing. As long as investors believed the system would continue functioning, money flowed in and stability appeared sustainable. Then, confidence weakened. Capital became harder to attract. Financing became more expensive. The illusion of stability began to break apart. Lebanon was different in many ways, but the pattern was familiar. Both systems depended on outside money. Both relied on confidence. And both discovered that confidence can disappear surprisingly quickly. By the mid-2010s, the conditions supporting Lebanon's model were beginning to change. Regional instability created uncertainty. Foreign investors became more cautious. Growth in remittances slowed. The flow of dollars that had sustained Lebanon for decades was no longer keeping pace with the system's growing needs. And that exposed problems that had been hidden for years. Government debt was enormous. Productive sectors remained weak. The economy still depended heavily on external financing. Without fresh dollars, the system came under pressure. Policymakers attempted to buy time. Banks offered attractive returns. Authorities reassured the public. The message remained the same. Everything was under control. But the old solutions were becoming less effective. The machine was demanding more fuel than it was receiving. For the first time, investors began noticing. Then depositors noticed. Then confidence itself began to weaken. That moment mattered more than any political speech or economic statistic, because confidence had become the foundation of the entire system. Once people began questioning that foundation, the structure above it became vulnerable. Fewer dollars entered the country. More pressure accumulated beneath the surface. The process remained largely invisible. No dramatic headlines, no obvious catastrophe. Just a widening gap between appearance and reality. This was the collapse before the collapse. And then, the impossible happened. Banks began restricting withdrawals. People who believed their savings were secure suddenly discovered they could no longer freely access their own money. Trust evaporated. Families lost access to retirement funds. Parents worried about education savings. Business owners struggled to operate. The financial crisis quickly became a crisis of daily life. At the same time, the Lebanese pound entered a downward spiral. For years, the currency had appeared stable. Then, confidence weakened. The pound lost value. Prices surged. Imported goods became dramatically more expensive. Inflation spread throughout the economy, eroding purchasing power and financial security. Businesses closed. Investments disappeared. Young professionals left the country in search of opportunities elsewhere. Public frustration spilled into the streets. Protests spread across Lebanon. People were not simply protesting economic hardship. They were protesting the collapse of a system they had trusted for decades. And perhaps the most devastating impact was psychological. Trust in banks weakened. Trust in institutions weakened. Trust in political leadership weakened. Confidence disappeared across society. The World Bank later described Lebanon's collapse as one of the most severe economic crises globally since the mid-19th century. Yet despite how extraordinary it seemed, Lebanon's story was not unique. History had already provided warnings. Before its debt crisis, Greece appeared stable and prosperous. Borrowing costs remained low, investment flowed into the country, and living standards improved. But beneath the surface, debt was growing faster than the economy's ability to support it. As long as confidence remained intact, the weakness stayed hidden. When confidence weakened, the illusion disappeared. The same pattern appeared in Weimar Germany. There, trust in money itself collapsed. Inflation spiraled out of control. Savings were destroyed, and confidence in institutions deteriorated. Different countries, different eras, different triggers. The same underlying force, confidence, because confidence allows governments to borrow, banks to function, and currencies to hold value. And perhaps most importantly, it allows vulnerabilities to remain hidden. When historians examine major economic collapses, they often discover the same pattern. Prosperity creates confidence. Confidence encourages borrowing. Borrowing creates dependency. Dependency creates fragility. Fragility remains hidden beneath apparent success. Then confidence disappears. And suddenly, weaknesses that took years to develop become impossible to ignore. Lebanon followed this pattern almost perfectly. Its collapse appeared sudden. In reality, the conditions that created it had been developing for decades. Which is why Lebanon's story matters far beyond Lebanon. The world is filled with economies built on confidence. Governments depend on financial markets. Banks depend on trust. Investors make decisions based on expectations about the future, and that creates an uncomfortable reality. The greatest risks are often hidden beneath periods of apparent stability. A booming market does not guarantee resilience. A stable currency does not guarantee strength. A growing financial sector does not guarantee sustainable prosperity. History repeatedly shows that appearances can be deceiving. Lebanon's collapse reminds us that economic strength is not measured by how successful a country looks during good times. It is measured by how well it survives when conditions become difficult. Lebanon did not collapse because of a single event. The crisis became visible in 2019. But the foundations of that crisis had been forming for years, perhaps decades. What makes Lebanon's story so unsettling is that millions of people believed they were living inside a successful system, while that system was quietly becoming more fragile. The banks were real. The buildings were real. The prosperity looked real. But beneath it all, the foundation was weakening. And when confidence finally broke, the illusion broke with it. The warning signs were never completely hidden. Rising debt, dependence on outside money, an economy increasingly reliant on confidence rather than production. Yet almost nobody believed the system could fail because it had worked for so long. That is the danger of financial illusions. The longer they survive, the more permanent they appear. Until one day they don't. And history suggests that is often how the biggest economic crises begin.